Forward and futures contracts are derivative instruments that establish an agreement today for the purchase or sale of an underlying asset at a specified future date and price. The primary objective of pricing these contracts is to ensure that no arbitrage opportunities exist between spot and derivative markets. Forward contracts are privately negotiated over-the-counter agreements, while futures contracts are standardized and traded on organized exchanges. Although their structures differ, their pricing principles are closely related because both derive value from the same underlying assets. The program emphasizes understanding forward and futures pricing because these contracts are widely used for hedging, speculation, arbitrage, and financial risk management across global financial markets. The pricing of forward and futures contracts is primarily based on the cost of carry model, which links spot prices to future delivery prices. The cost of carry includes financing costs, storage costs, insurance expenses, and any income or benefits generated by holding the underlying asset, such as dividends or convenience yield. For financial assets without income, the forward price generally equals the spot price compounded at the risk-free interest rate over the contract period. If the underlying asset provides income, the present value of expected income reduces the forward price. These pricing relationships ensure that investors cannot earn riskless profits through arbitrage by simultaneously trading in spot and derivative markets. Arbitrage plays a central role in maintaining fair forward and futures prices in financial markets. If futures prices rise above theoretical values, traders may implement cash-and-carry arbitrage by purchasing the underlying asset in the spot market while simultaneously selling futures contracts. Conversely, if futures prices fall below theoretical values, reverse cash-and-carry arbitrage may become profitable. These arbitrage activities force prices back toward equilibrium. The no-arbitrage framework assumes efficient markets, low transaction costs, and the ability to borrow or lend at risk-free interest rates. Through these mechanisms, forward and futures prices reflect current spot prices, financing conditions, expected income, and market expectations regarding future asset values. Although forward and futures pricing models are similar, differences may arise because futures contracts are marked to market daily while forward contracts settle only at expiration. Daily settlement creates reinvestment effects that can cause futures prices to differ slightly from forward prices, particularly when interest rates are volatile or correlated with underlying asset prices. For many financial assets, however, the difference between forward and futures prices is relatively small. Commodity futures pricing may also incorporate convenience yield, reflecting the non-financial benefits of physically holding the commodity. Factors such as storage constraints, seasonal demand, and market liquidity can therefore influence futures pricing relationships in commodity markets more significantly than in purely financial asset markets. The program highlights forward and futures pricing as a fundamental component of financial engineering and risk management. Accurate pricing models allow market participants to hedge exposures, evaluate arbitrage opportunities, and manage portfolio risks effectively. Banks, corporations, hedge funds, and institutional investors rely heavily on forward and futures contracts to stabilize costs, protect investment values, and speculate on market movements. Understanding the relationship between spot prices, interest rates, carrying costs, and expected future values is therefore essential for financial risk professionals. As derivative markets continue to expand globally, mastery of forward and futures pricing principles remains critical for analyzing market behavior and implementing effective risk management strategies.